As first-time investors, we can sometimes put massive amounts of pressure on ourselves to try and get everything perfect and to try and get everything right. Unfortunately, when I was just getting started, it didn't all work out perfectly and it didn't all work out right, which is why in today's video, Simon and I wanted to talk about a bunch of the major mistakes that first-time investors make and we've made that can keep you out of trouble and help you make a better decision. Sweet, bro. So what's one of the biggest mistakes we sort of see when talking to literally hundreds of first-time investors a year?
Now, before we get into the mistakes that some people generally make, I'll tell you what, it is really nice to have a mentor or a coach that's made the mistakes already and you can sort of watch that and avoid making them. And that's essentially the intention from this video, because I'll tell you what, you've made a few mistakes and it's helped me avoid making them.
I was just thinking about that when I was like, yeah, the mistakes that Simon and I have made. Like Simon's portfolio has been literally perfect and it's full of like the 1,000 things that I've fucked up during this journey. So hopefully you can have a laugh today. Hopefully you can learn from some of my mistakes. And most importantly, like Simon always said, move through them and learn from them, grow from them and make better decisions moving forward. So what's the first one we normally hear?
Look, the first one is a little bit of a different one, and it is operating out of emotion as opposed to logic. And I find a lot of beginner investors do this because they just don't have the knowledge or the experience or the education to make a logical decision. So they, lean into that emotional side of things and they will generally end up getting the wrong result. I saw a crazy study that actually indicated that 60% of first-time investors lose money in the first 5 years. And this is because they're going with emotion as opposed to logic. But what about yourself? Like, what is one of the mistakes that you've made or that you see a lot of younger or beginner investors make?
One of the biggest mistakes that I made, and I was talking to another young fella, I won't mention his name on camera yesterday, but effectively like chasing easy money. So one of the biggest mistakes that I was making was chasing the next boom suburb or the property with the most insane cash flow or what I thought was under market value and trying to make 10 grand or 20 grand on the way in instead of chasing fundamentals. And now that I know what the fundamentals are, houses in metro markets, close to the city and the beach, quiet streets with good quality houses that you'd raise a family in with a nice big block of land, it's easy. But back then I had no idea. So it was like shiny, 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 cash flow, regional, whatever I could get that I thought would get me further quicker. And it ended up putting me back years and years.
Now, the second one for me, I hear an absolute lot, and this is taking the advice from the wrong people. Taking advice from people who aren't where you want to be, that don't have as much experience and are pointing you in the wrong direction. This could be people that love you and just want the best for you, but they're not pointing you in the right direction. Or it could be somebody who just doesn't have your best interest at the top of their mind and they're forcing you into something that may not actually work for you, which really comes into one of the other ones that you wrote down, Ben, which is investing without a plan.
Yeah, so I think it's very, very tricky at the start to know all of the different bits and pieces that are going to make you successful. Like, you don't have a perfect team when you get started. Of course, you don't have a perfect plan. You may understand some of the fundamentals in the market, but I was focusing on many of the wrong things and missing the 5 or 6 big rocks that completely changed the dial on my long-term results. So investing without a plan is a tricky one, and it's as simple as this, guys. Like, choose where you want to be in the future. And I think for everybody, it should be financially free with choices in their life with at least 100 grand a year of passive income from their properties. So if you look at that, 100 grand a year of passive income from your properties, then maybe you need somewhere between 2 and 3 high quality assets that are bought today that you hold over the next 20 or 30 years to get you to that place once you've paid them off outright. And it doesn't have to be harder than that.
And what you got to do here is like flip the script. What I find a lot of young people like myself, like you, we want that short-term money. We want to, reap the rewards today and we don't delay the gratification. But if you actually flip the script and go for those longer-term properties from the very get-go, get a little bit of experience, create that plan, build your team of advisors, understand the nuances, the ins and outs of property investing. And then from that base level, then you can start doing some more short-term projects and you'll have a lot more experience, a lot more knowledge, and probably the team to support you in doing that as well. And I find that's what a lot of our successful clients do. They focus on the long-term first, then they scale it back and do short-term deals to pay off the debt.
I think another one that I see all the time is overvaluing, it's called location bias, and it's overvaluing what you know and undervaluing the unknown. And we do this as humans all the time. We stay within our comfort zone, which is the safe place to be for survival, but it's a dangerous place to be as an investor. And so when I bought my first property, like most people, I bought it within 10 Ks of where I grew up. Luckily, it was Sydney, and Sydney at the time had done no growth for the 10 years leading up to that point at the end of the GFC. But if you were investing in Sydney right now, for example, and it's done an average of 10+% per year for the last 10 years, then you're buying like very, very close to the top of that market right now. A lot of the future pricing may have already been priced in. And instead of getting a great house for 600K like you could have 15 years ago, you're getting a shitty one-bedroom unit in the middle of nowhere because it's close in a market that feels safe, but is actually the worst thing you can spend your money on. So I think just recognizing that if you're in Sydney, Melbourne, Brisbane, or Perth, there are other places, and it's about looking at the fundamentals and seeing what's done okay in the last 10 years, knowing that those markets have all done well longer term, and then going for that quality house or townhouse close to one of those markets and, you know, buying what you can afford.
Couldn't agree more. And then the last one that I wanted to mention is I find a lot of first-time investors, a lot of beginner investors get sold into purchasing off-the-plan units, off-the-plan townhouses, and house and land packages. Now, I want to say that I've seen people generate amazing returns from off-the-plan units, townhouses, and house and land packages, but it's just the average. It more often than not doesn't work out. And, you know, what you got to remember here is the power is in the land, not what's sitting on top of it. And what you find in these apartments, townhomes, and even most house and land packages is the land component is absolutely tiny. You're also getting a beautiful brand new property, which is great for the depreciation benefits and the low maintenance that you get from it. But there's no way to manufacture value. There's no way to add value to those properties. And you're paying for the profits to have that brand new one. You got to think about everybody that needs their cut there. You got the developer, the builder, and whoever's selling you into that thing. That are all trying to make a profit from it. So it can sometimes just minimize the potential returns that you'll get there. So not saying that they're the worst investments, but just be cautious and don't, you know, just go for that because the shiny new thing looks good.
Be very, very careful. I got caught on those things personally as well because I did want to get rich quick. And everybody wants to get out of a 60K job to have 60 grand a year of passive income. Of course, when you're in your 20s, 30s, 40s, we want to be spending time with our kids, of course, but just be aware and focus on the fundamentals.
And at the end of the day, we're all going to make mistakes. You know, when you look back on your journey as a property investor, there's always going to be things that you would change and whatnot. And that's just a part of the process. That's just a part of the journey itself because, you know, you learn from those mistakes, you learn from those lessons, and then you make better decisions in the future. But the definition of insanity is doing the same thing over and over again and expecting a different result. So as long as you learn from the mistakes that you've made and you adapt and you change when required, you know, it will all work out at the end of the day.
So for those of you seriously thinking about buying your first property in the next 6 to 12 months and you want to avoid some of the mistakes that I have and learn from mine and Simon's experiences having bought more than $450 million worth of property now for our clients over the last 8 years, we would love to offer you a one-on-one strategy session. Just jump over to www.pumkedonproperty.com and book that session in where we can talk about where you are today, where you would like to be longer term. We can educate you on the fundamentals and the market as it stands today. And then you can take that and go and absolutely smash it on your own or potentially become one of the extremely small number of clients we choose to work with each month. But either way, we wish you all the best on this journey. You're not going to get it perfect first time around, but holding long-term good quality assets will completely change your life, create freedom and choices in your future that you can't even imagine right now. And we wish you all the best.
Woo, that's a wrap.
That's a wrap.
Have a spin. Bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that. So nice. Oh.